The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Silvia Amaro. These are your headlines. The European equities search for direction as investors await minutes out of the Federal Reserve later today, with the Stoxx 600 still on pace for its best year since 2021.
Russia vows to respond as it alleges a Ukrainian attack on President Putin's residence, hitting hopes for a peace deal between the two countries. And a flight to safety sends the price of precious metals higher, with Dr. Copper on track for its biggest annual rise in more than 15 years and pushing up mining names in early trade.
Well, we are in the final trading days of 2025, and what a year it has been. A roller coaster on stock markets, really bumper returns in many parts of the market. Now it's the metals market that's taken the baton and is running with it into year end. So we are shaping up for an exciting period right up until tomorrow, until the 31st.
Absolutely. It's till the very last minute. Also thinking about it from a European perspective, we have seen the European benchmark actually on track for its best year since 2021. So let's see what's going to happen over the next couple of hours. Worth keeping in mind that tomorrow, for instance, a couple of the bourses will be closed for trade, including Germany and Italy. And for the time being, on this final trading day for some of the European bourses, this is the picture at this hour. We have just a little bit of green across the major markets. I will actually take you to Italy, where the FTSE MIB is the one making the biggest gains at this hour. But in terms of the sectorial breakdown, let me show you what's happening at this hour as well. We're 1 hour into today's trading day. At the top, basic resources, we are up about 1%. Karen and I have been discussing indeed these volatile days in terms of metal prices. That is one of the reasons behind some of the moves we are witnessing at this stage for basic resources. But banks also posting gains of about 0.8% at this stage. But let me take you to the worst performing sector so you get a full picture of what's happening at this hour. We have only a little bit of pressure for food and beverage, healthcare as well. So not a huge momentum to the downside at this hour. So let me take you to Wall Street and show you what are the expectations as we approach the open later today. It seems it could be a mixed start to the trading day. Let's see what will happen. Of course, all eyes today on what the Fed minutes will be telling us. Investors will be eyeing that very closely, Karen, of course, as they are trying to project what's going to happen in 2026 as well.
Yeah, it's one of the key factors if we get a dovish Fed or not into next year and what that means for markets. Well, speaking of which, markets are divided on the outlook for the Fed next year, with an almost 50-50 split on a hold versus a cut in March. According to CME's Fed Watch tool, the end of 2025 has seen the Fed become more divided as it grapples with whether it has fully tamed inflation, whilst also monitoring the impact of rate policy on the labour market. And speaking of which, there is one rule that the market was looking at about 12 months ago, the SARM rule, and this was what the unemployment rate was flagging around any potential for a recession. Keep in mind, any increase over the low over a certain period of time could flag a potential recession. So speaking to CNBC, former Fed economist Claudia Sahm, and don't forget it was the SARM rule that it was called, weighed in on her predictions for next year.
I think they're going to be willing to tolerate some more, pain in the labor market, maybe an unemployment rate that drifts up a bit more from where it is right now before they really start to act. And again, on the demand side, we just don't see that kind of deterioration. We don't see the forcing to get them to cutting soon. I think the cuts from the Fed will come, but they're going to be a story about the second half of the year, not the first half.
And staying with the latest when it comes to the Fed, the President of the United States, Donald Trump, has once again taken aim at the Fed Chair, Jerome Powell, saying he would love to fire the Fed official, and again, calling on him to resign. Trump levied the new threats at a press conference in which he said he plans to announce a new chair sometime in January. The final candidates include the frontrunner Kevin Hassett, the former Fed governor Kevin Warsh, as well as the more conventional choice of current Fed governor Christopher Waller, and the black horse, perhaps here, Rick Ryder of BlackRock. Time now to discuss what's going on here, plus the outlook with our next guest. Florian Jelpo, head of macro at Lombard Odier, is joining us this morning. Florian, great to have you on the show. Look, we were discussing the outlook for the Fed earlier this morning here, and I just would like to get your assessment in terms of how you are looking at the comments from the president, and to what extent the next Fed chair could be one of the key drivers for markets in 2026.
Hi, everyone. Thanks for having us. I think it's one of the key elements we need to figure out, essentially for the first half of next year, where the nomination and the change in the governance of the Fed will have the main impact in terms of rates, in terms of forward guidance, and of course in terms of the US dollar. First step. The minutes we'll get today are one step in that direction, just to better understand how the decision-making process is currently balancing fears about inflation and fears about the job market, and see how the government is progressively shifting, because the group of governors itself is thinking ahead of how this evolution could impact their decision-making process. So in our view, one person cannot change globally the direction of monetary policy in the US. It's a very consensual way of doing this, of delivering decisions. That has been the case for the past 20, 30 years globally. We don't see a significant change, but we see an increased sensitivity to the second pillar of the Fed, meaning a greater attention to economic growth and the job market.
Interesting. You're the second guest that highlights that to us this morning. Florian, I would also like to get your thoughts on the dollar in the context of perhaps a more dovish Fed in the new year. At this stage, if you look at the performance for the greenback year to date, we are seeing levels of pressure of about 10%. Do you think that is likely to continue in 26?
It's part of our view. We continue seeing a downtrend in the US dollar, not just for monetary policy reasons, because of the great readjustment that the US economy has entered with the new US administration. So you get two key factors. One is your tariffs that are weighing on your long-term productivity gains, and the fact that the AI productivity boost is probably behind us more than ahead of us at the moment, meaning the bulk of the impact priced into markets. So you see a stabilization of productivity gains coming from AI, plus this deterioration of productivity coming from the re-onshoring of manufacturing activities. This is a negative force for the US dollar. And the second thing would be a few more steps in the direction of dovishness. For now, we're still expecting 2 rate cuts next year, essentially in the later part of 2026. And with that, we could see also a few more percentage points down on the greenback, especially in face of other regions where productivity gains are only starting on the back of AI, especially Europe and Asia globally as a whole.
Florian, can I dig a little further into the productivity gains from AI? Because I remember this time last year, it was very hard for a lot of economists to anticipate what that would look like in 2025. Is it any clearer that we'll see a real step up in those productivity gains, and whether that will be across economies as we go into next year?
What we're seeing at the moment, when you think of the AI impact, you need to think a difference between what's happening in terms of investment, in terms of capex, and the benefit of capex, which is an increase in productivity, right? What we can anticipate at the moment is 2026, especially in the US, should see a continuation in the AI investment factor, and this is a very large contributor, an unusually large contributor for 2025, and we should see exactly the same thing in 2026. So it's a plus in the GDP box in the US. Now the second thing is productivity gains. AI enablers and AI adopters. We need to gauge the impact of AI on the adopters. For now, it's still very difficult to gauge. What we can see is a slowdown in the rhythm of hiring on the job market. This is a given. But what we fail to see for now is what it does globally in terms of surge in productivity, especially in the face of demographic factors. So you see, the investment is more or less a given. It's a positive source of GDP, and it's a given for 2026. Now, the productivity gains themselves are more unsure and more difficult to gauge, as you mentioned. Last year it was the case, and it still remains the case today.
Florian, let me ask a very simple question about whether to invest in the S&P 500 into next year. Because if you look at what the performance has been so far this year, up more than 17% year to date, but not much for this month. Although that said, it is the 8th positive month in a row. So very hard to recognize that there's been a Santa Claus rally because we had that dip mid-month and we've just been recovering off some of those lows. So a little bit disappointing if you're looking for those big rewards into year end. That said, would you buy today, now as we sit about 0.5% off the all-time high in the S&P 500, would you buy the index going into next year?
We're extremely comfortable holding S&Ps in our portfolios. Has had the S&P in our portfolio at the moment, and we should continue doing so in next year, in 2026. The thing is, S&P performs out of price progression. In our portfolios, we're also looking for something else, meaning dividends. So we think that 2026 should come with a more balanced growth, which doesn't play against the S&P. Okay, it plays the game of the S&P, of course, but also it plays the game of other regions such as Europe, such as Asia, where you can harvest basically dividends as a source of performance, probably dominating the progression in terms of prices. The second thing I would think for next year is in the US. You're still living in a zone with positive real rates. And when you look at forwards, this market expects that this positive real rate situation should continue in the future. That situation normally profits more to large caps than to smaller caps. So the S&P in the US is probably the perfect place to be because it's broader than the Nasdaq. You're concentrated in tech, of course, but you have other companies than the tech sector. And on top of that, you're still in this realm of large caps, which usually do better when real yields remains very positive as they are today.
Florian, it is this time of year that a lot of investors and traders look back and say, gosh, I wish I'd been invested in that. I wish I'd been trading that particular asset. Commodities is one of them. If you look at the ascent we've had since the lows of Liberation Day, incredible gains, chasing some fresh peaks that we've had in recent years. That said, there have been higher levels that you've seen on the basic resources basket. Is there a catalyst at play here that suggests there are further gains to come in 2026?
If we see gains in commodities next year, in our view, it shouldn't be as concentrated as it's been in 2025, meaning essentially metals and precious metals as a leader to global commodity indices. The way we're seeing next year is like we could have slightly more growth from your laggard economies. I'm thinking Europe, of course, as a whole, but other sources of the world where GDP growth has been slower than usual, let's say. And that environment creates demand pressure. And when you see such a large number of countries, the IMF expects 65% of the world, of the countries in the world, to see a reacceleration of their growth. When something like that happens, the place you want to be is, of course, in commodities, but not essentially in precious metals. You want to be in cyclical commodities where you can capture that demand impact. So I would we're seeing commodities as one of the top performers for next year in our mutual portfolios. But the source of that performance is more cyclical commodities than defensive precious metals.
And Florian, you've highlighted you're comfortable with your S&P 500 position. You are quite bullish also in terms of the outlook for commodities here. But what is the outlook for Europe and what do you want to own at this stage? Because, for instance, if you look at the Italian market, it's actually on track to end 2025 as the best year performance since 1998. Can this continue?
It's a fair question, and it's one of the key questions to our portfolios. We've been having an overweight for Europe for 6 months, which has played as an interesting hedge against the risk that attached to the AI story. The AI story is especially concentrated in the US. So basically, when you're overweighting European equities, you're creating some defensiveness in your portfolio without lagging too much, which is a very interesting position to hold in an equity portfolio and in a multi-asset portfolio. Now, we're still expecting this trend to go on, especially in the next 3 months, for two main reasons. First, we see a continuation in the European recovery. Retail sales in Spain this morning were still excellent. And we think that it's one of the many indications that Europe at the moment is doing decently and improving. That's the first thing. And the second element is something silly, which is seasonalities. Over the past 4 years, what we've seen that the first 3 months of the year, investors have realigned their positioning out of US equities towards European equities. And given the mismatch in terms of liquidity on both investment spaces, well, we've seen European valuations rising. So you see, this Europe story is very interesting at the moment because it's a natural hedge. Again, the risks attached to your AI valuation, which is one of the key risks for next year, first thing. And also, there is upside. There is upside because European demand is currently improving. One risk to that trade and the ECB being too hawkish and refusing to admit that basically we need potentially at least to keep rates where they are at the moment.
So I just want to take stock of where we are as we approach the year end. If you were positioned, for instance, in the FTSE MIB, as I've highlighted, as we are looking at the end of the year, the main market on track to post gains of about 30% on a year to date. If you look at the NASDAQ on a year to date basis, we're up about 21%. So based on what you just said, do you expect that in 2026, the whole story around Europe actually outperforming the United States could actually be front and center?
That could go on, especially in the first part of the year. That first part of the year is, again, typically positive for Europe. And markets are still very cautious about the valuation of AI. And as long as that will be the case, you could still see Europe outperforming, or at least performing side by side with US equities, which would already be an achievement given their relative performance over the past 15 years. We're seeing Europe at the moment as a value play, an attractive value play that could become momentum progressively through the first 6 months of the year.
Florian, you've been writing a lot around small caps versus large caps, and it has been a year where everything really has marched higher. Even the Russell 2K has managed to try and mark higher. What happens next year as you look at real rates? I know you've been extrapolating out here about the performance. Which end of the market is better placed in your view?
What's fascinating about smaller caps is that if you make a divide between the countries where, again, real rates are positive and where real rates are still negative, Japan, Switzerland, you see a very different performance of small versus large. And that's something everyone should remember. One of the key factors to the smaller caps to play out in your portfolio is the situation in terms of funding conditions. So in the US, we are in real yield territories which are positive, and as long as it will be the case, the Russell will struggle in front of the S&P, and we need basically either inflation expectations or nominal yield to move so that real yields become less positive for the smaller caps to play out. But there are plenty of places where you can play your small caps, especially Switzerland and especially Japan, where they become very attractive plays and very trendy plays. Why? Simply because mainly because real yields are negative still out there. Even in Japan, even with the hawkish BOJ, at the moment, real yields remain in negative territories.
Florian, some very strong calls there. I think the viewers getting their money's worth today. We do appreciate all the tactics going into next year. Florian Ilepo with us, head of macro at Lombard Odier. Coming up on the show, Meta announces another AI acquisition as the AI arms race continues to heat up. We'll have the details next.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
To Squawk Box Europe. Now, the Kremlin has vowed to continue fighting after an alleged Ukrainian attack on President Putin's state residence. Russia said that the alleged Ukrainian drone strike would trigger, quote, the most serious response. Meanwhile, the Ukrainian President Vladimir Zelensky called the allegation a, quote, complete fabrication intended to justify attacks against Kyiv. Speaking to reporters in Mar-a-Lago, the U.S. President Donald Trump said he heard about the attack, adding he would be angry if any offensive jeopardized the peace talks. And staying in the geopolitical space, the U.S. leader has also claimed that the U.S. has carried out an attack on a facility in Venezuela as part of its ongoing campaign to counter alleged drug trafficking by the country. The strike was reportedly carried out by the CIA and, if confirmed, would be the first known U.S. strike on Venezuelan soil.
The US government has reportedly granted an annual license to SK Hynix and Samsung Electronics to allow them to move chip manufacturing equipment to China next year. That's according to Reuters. The approval could provide a temporary relief for the South Korean firms, which have benefited from exemptions to Trump's chip export restrictions. But those exemptions are set to expire tomorrow. Meanwhile, Meta has announced it will buy Manus, which is a developer of general-purpose AI agents, as the tech giant ramps up its acquisitions of artificial intelligence startups. The Singapore-based developer was originally founded in China and launched its first AI agent earlier this year. In a statement, Meta said the deal was aimed at boosting AI innovation for businesses and enterprise products. Let's just put a little bit of flesh on the bones here. So, Singapore-based company, but with Chinese founders. One of the founder, Xiao Hong, his nickname is Red. So very interesting nickname there. But it also suggests here that you've got Meta, which has been very focused on building AI, big capex spend, that is now tapping the Asia ecosystem to build out its future. This particular company, it was in the headlights earlier in the year. The spotlight claimed as it showcased an AI agent that was capable of producing deep research reports. Do you think about a lot of the companies that have been relying on entry-level graduates and new employees to do that? And you can hear a lot of the investment banks not taking on as many graduates or those entry-level positions. These are the sort of companies that are relying on research like that. Also was capable of building out a custom website. So the capabilities on both sides extraordinary, and exactly sort of the application phase that market is now looking at. So it does suggest that Meta is going after Google, OpenAI, and the like, trying to build out its AI capabilities. So potentially a fairly decent segue for the company, and at a $2 billion valuation, so not small change.
And it just highlights here the competition and how fierce it is in terms of the AI sector. I would also look at the angle that you brought up in terms of the fact that this is a company that initially began in China, because we started this year exactly discussing who is going to win the AI race. Is that China? Is that the United States? Of course, we have the DeepSeek event as well that shaped a lot of the market narratives at the start of this year. So this perhaps just highlights here how there is a room for potential deals and for potential further developments looking at Asia as an ecosystem here for AI development. But then, of course, as you've highlighted, Karen, as well, it also shows the investment and how much focus Meta is putting on AI. The question is whether their philosophy is going to pay off.
Well, the puzzling part here is that the deep investments you've seen from Meta in AI have been really designed to maximise the advertising spend still. It makes the advertising more effective, getting in front of the customer so they know their customer better. But what the capabilities of Manus have been so far almost suggest another play on the enterprise customer. This is, don't forget, an area where Meta had over the years had ambitions to delve into, but was not necessarily hugely successful. So you've got the likes of Microsoft with Copilot using a lot of these services, very much cleaning up an enterprise still. I do wonder, with these capabilities of producing detailed research reports and custom building websites, whether Meta, as it is going to fold some of Manus's services and integrate it into some of its social media products, is going to have another stab at the enterprise market. Just putting it out there, early days.
Let's see when it will happen, but no doubt an exciting time in AI.
Exactly. Let's watch it closely. Now, beyond the big names in technology, a new community is emerging in Hangzhou, where young entrepreneurs experiment with creative AI projects in a campus-like suburb that's been dubbed a Coder Village. CNBC's Elaine Yu takes a closer look.
A mix of misty lakes and modern skylines, Hangzhou inspired artists for centuries before nurturing tech giants. Now, the Chinese city is chasing a new identity around artificial intelligence, with a kaleidoscopic scene. While the likes of Alibaba and DeepSeek battle over frontier AI, a leafy hipster meets hacker suburb has become ground zero for AI's quirkier side. Coders and aspiring entrepreneurs have flocked to Liangzhu in the past 2 years, drawn by its creativity, free lifestyle, and sense of camaraderie. Unlike the city's so-called Six Little Dragons, which are knuckling down on robotics and brain-computer interface, Liangzhu's residents are building gamified fitness trackers and ADHD-friendly calendar tools. Residents of Liangzhu call themselves villagers and count Silicon Valley and Chinese big tech alums among them. Alex Wei, an entrepreneur who moved to Liangzhu this year, is interested in how AI can meet people's emotional needs. He is developing an AI app based on traditional Chinese divination tools. Liangzhu's low commercial pressure is part of its appeal.
You can come to Liangzhu with 1,000 renminbi and leave with your product demo. It's a very inclusive place. You don't have to have a unicorn product. You'll find support even for a small app serving 1,000 people.
Many are eyeing global customers. Several of Wei's projects first launched in North America. The plan is to tap China's hardware supply chains and offer competitive prices worldwide. But China's domestic competition and customers' reluctance to pay for software have also pushed startups to target users abroad, according to observers. Investors have noticed. A monthly demo day that started in a living room now draws founders and backers from across the region and beyond. While praising founder creativity, investors warn some startups simply patch AI onto products for marketing, from air conditioners to mirrors checking your sunscreen. Not every product will stick. Whether consumers want them is an open question, but some founders pitch AI not for productivity, but comfort. Elaine Yu, CNBC, Hangzhou, China.
China is now prioritizing the development of humanoid robots to gain an upper hand in its tech battle with the US. For more on the story, you can check out CNBC.com.